NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks, which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. These practices are sometimes further accentuated by what appears to be a push effect as business targets drive retail credit growth rather than its actual demand. I am not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening. Bilaterally, we are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay and incentive structures, some of which appear to be purely target-driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs, including MFIs and housing finance companies, follow sustainable business goals, a compliance-first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option. Coming to external sector, India's current account deficit, that is CAD, widened to 1.1% of GDP in the first quarter of this financial year, that is 24-25, and this was on account of higher trade deficit. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within the sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, have seen a turnaround from the net outflows of $4.2 billion in April and May this year. They have turned from net outflows. In April and May, we had net outflow of $4.2 billion. Now they have now turned to net inflows of $19.2 billion during June to October, and this is the figure till 7th of October. Foreign direct investment, that is FDI flows, remain strong in 24-25, as both gross and net FDI flows have improved in April and July. While external commercial borrowings moderated, non-resident deposits recorded higher net inflows compared to last year. India's foreign exchange reserves have already crossed a new milestone of $700 billion. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. And when I say key external sector vulnerabilities continue to improve, I have backed it up by the data in the footnote of the statement. On the whole, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first relates to responsible lending conduct, levy of foreclosure charges, and or prepayment penalties on loans. The Reserve Bank has taken several measures over the years to safeguard consumer interest. As part of these measures, banks and NBFCs are not permitted to levy foreclosure charges or prepayment penalties on any floating rate term loan sanctioned to individual borrowers for non-business purposes. That is, for purposes other than business. It is now proposed to broaden the scope of these guidelines to include loans to micro and small enterprises, that is MSEs. A draft circular in this regard shall be issued for public consultation. The second announcement relates to discussion paper on capital raising avenues for primary urban cooperative banks, that is for UCBs. The Reserve Bank has undertaken several initiatives in recent years to strengthen the UCB sector. Such initiatives include issuance of regulatory guidelines in 2022 for issue and regulation of share capital and securities by the urban cooperative banks. To provide more flexibility and avenues to the UCBs, that is urban cooperative banks, to raise capital, a discussion paper on capital raising avenues for UCBs will be issued for feedback and suggestions from stakeholders. The third announcement relates to creation of Reserve Bank Climate Risk Information System. Climate change is emerging as a significant risk to financial system world over. This makes it necessary for regulated entities to undertake robust climate risk assessment, which is sometimes hindered by gaps in high-quality climate-related data. To bridge these data gaps, the Reserve Bank proposes to create a data repository, namely the Reserve Bank Climate Risk Information System, or in short RBCRIS, Reserve Bank Climate Risk Information System, that is RBCRIS. The next announcement relates to UPI, where we are enhancing certain limits for the various transactions. UPI has transformed India's financial landscape by making digital payments accessible and inclusive through continuous innovation and adaptation.